We have something significant in today's video. 3 of the most prominent figures in the financial industry, Tom Lee, Cathie Wood, and Kevin O'Leary, are offering their predictions for the future of cryptocurrency, blockchain technology, and the potential impact of this new wave of on-chain financing on Wall Street. For the simple reason that for more than 10 years, we have discussed the possibility of moving on-chain. Ever since Bitcoin's infancy, this concept has been around. However, on a large scale, it never occurred. All of a sudden, the impetus has arrived. And what gives it such power? A fresh swell of incentives and rules. This is the type of setting that is compelling conventional banking to begin constructing blockchain-based systems. This has moved beyond the realm of theory. A lot of people are actually making digital payments with blockchain technology. When that occurs, it's not enough to simply discuss cryptocurrency. Actual crypto transactions must also take place. Going on-chain is what it means. Your money isn't being advised here. This is the most bizarre part. The first time this change has occurred, it is not due to hype. What's driving it is practicality. Ethereum, Solana, and even XRP's ledger are being used by the same organizations who formerly deemed cryptocurrency a bubble to facilitate cross-border payments. Allow me to explain. This past weekend, during the unexpected rise in volatility, the system became overwhelmed as everyone hurried onto the blockchain. The network that is meant to represent the future of digital payments, Ethereum, the second largest blockchain on the planet, actually froze. It was overwhelmed. Ethereum can be compared to a toll booth located on a one-lane freeway. There is a transaction for every vehicle on that roadway. No issues with typical traffic conditions. All those cars are waiting in line, honking at the toll gate. Then, volatility hits, and the billions start flowing through. Additionally, you can skip the line if you have the means to do so. If you need to go through it quickly, you can pay more. However, some individuals were shelling out more over $1,000 over the weekend simply to send a transaction. Just picture yourself shelling out $1,000 for gas instead of $2 for a cup of coffee. There is no scalability in that. That is anarchy. Now, we get to the meat of the story. Reason being, XRP saw a rather peculiar occurrence when Binance and Ethereum were both suffocating under volatility. However, before we delve into that, it's important to comprehend how the wealthiest 1% of investors are preparing for this very change. Namely, how they identify asymmetric opportunities like XRP before they gain widespread interest. In the XRP Millionaire Blueprint, I detail precisely this. The best investors are getting ready for this once-in-a-generation change in global finance. And this comprehensive guide has a video, infographic, and text to show you how they're doing it. Just below this video, in the pinned comment, you'll see it. We may discuss what transpired now. Excuse me. While the market was closed for the weekend, XRP fell as low as 180 before quickly rising to 233. The price action is out of the ordinary. This is particularly true for an asset that has recently overcome the SEC case, the largest legal obstacle to virtual currency. Also, the SEC has formally approved for additional review numerous spot XRP ETFs, which was next to impossible under the previous administration. You would think XRP would be exploding even higher now that Gary Gensler is out of office and new legislative frameworks are coming in that really benefit digital assets. Then why isn't it so? 2 words sum it up: influence peddling. I know it seems like a no-brainer. However, a secret plot is not at play here. Organization is key. No one like you or me can make a difference as average investors. We purchase XRP to the tune of several thousand. Hundreds of millions of whales are in motion. The whole market responds in real time whenever those whales, or more crucially, the exchanges decide to shift their supply. My exploration of the blockchain data yielded the following results. Despite being the largest holders, the top 100 XRP addresses refrained from selling during the October 10th drop. Many were actually increasing their XRP holdings. Emphasis is key. Reason being, these wallets aren't just some casual traders. They're Ripple exchanges and institutions. Just so you know, most of the top 10 wallets are owned by Ripple. Since Binance is responsible for safeguarding customer funds, it is reasonable that they keep many. But closer inspection reveals that on October 10th, not a single one of these prominent wallets generated significant revenue. Binance offloaded almost 70 million XRP on September 22nd, 2025, the last major on-chain sale we can trace to them. This is a massive transaction, and it has the potential to temporarily lower the price on its own. Nevertheless, it was not the case during this collision. That happened a few weeks ago on October 10th. Who was selling if the top holders weren't? It retraces to the private exchange-only wallets that are behind the scenes. Simply put, exchanges have the capability to run their own operations off-chain. Their assets can be sold or transferred in a way that doesn't reflect on the public ledger right away. Even little changes in their XRP holdings can cause market fluctuations if they have large reserves. That's why you can't make sense of unexpected declines. Though the basics are more solid than they have ever been, the story gets more intriguing from here on out. Just like we mentioned before, Ethereum became stuck. Due to the exchange's inability to manage the traffic, Binance witnessed stablecoins momentarily lose their dollar peg. Concerning trust, it is a major concern. All the while, the XRP network continued to function, reliable, prompt, and spotless. When the market crashes, Ethereum gas prices skyrocket, and stablecoins begin to decouple from Binance, what asset will continue to settle transactions between financial institutions without a hitch? The significance of comprehending this moment is centered around XRP. Everyone is fixated on short-term price charts, but a fight is raging beneath the surface between traditional finance and innovative new forms of financing. The scaling problems with Ethereum persist. While Bitcoin is a solid form of currency, it is not a quick loan. In contrast, XRP has always been intended for use in institutional payments. With the legal hurdles out of the way, it is getting closer and closer to realizing its initial goal. Because of this, developments such as Cathie Wood and Tom Lee openly discussing the future of blockchain adoption will continue to occur. Why? Because they aren't interested in meme currencies or emerging trends. Real-time reconstruction of the future financial systems railroads is being seen by them. Instead of being mere commentary, Cathie's statement that this is the year when regulators and Wall Street finally got amendable to rebuilding on blockchain was a signal. There has been a meteoric rise in the stablecoin market, the approval of exchange-traded funds, ETFs, and the gradual lowering of the hurdles that prevented institutions from investing in cryptocurrency. After that, Tom Lee went even farther, saying that Ethereum may approach $60,000 in a scenario where Bitcoin reaches $2 million. Now, the significance of the representation is more important than whether or not those precise figures were hit. Strong institutional consensus that cryptocurrency is sustainable, not as an afterthought, but as the foundation for the upcoming financial revolution. Plus, XRP gains ground whenever that confidence increases. This is due to the fact that XRP is not aiming to displace Bitcoin, but rather address an entirely separate issue: worldwide payments made instantly and without hassle. That's why people are starting to talk about crypto as infrastructure instead of something dangerous. Decentralized blockchain technology and practical financial applications meet at the ideal spot, and XRP is at the very center of both. So, most investors miss the fact that XRP maintains sending money across the globe in seconds. Even when Ethereum's toll booth becomes congested, Binance experiences heat and stablecoins begin to wobble. They lose sight of the building that is taking place beneath them, amidst all the chaos and price fluctuations. Why? Because the major participants are ignoring the daily charts, as is customary prior to each ascent they are steadily collecting. The similar pattern also appears when reviewing the data in reverse. The whales gather whenever there is a retail panic sale. It's not a guess. Such actions are provable on the blockchain. Once again, the data from October 10th proves it. These high-quality wallets were not sold. They tacked on since they are aware of what is to come. And they are well aware of how quickly public opinion may change once the market as a whole learns about the goings-on behind the scenes. Regardless of which coin is now popular on social media, there is a real capital rotation taking on beneath the surface. the allocation of funds for infrastructure is at issue. Why? Because Wall Street didn't come for quick trades when they eventually chose to go into crypto. They arrived in search of command of the rails. These systems move trillions of dollars daily. This is the most significant year for blockchain in over a decade. According to Tom Lee and Cathie Wood, that is why, not due to conjecture, but rather to the fact that the regulations have been altered. Restriction is not the same as regulation anymore. Now it signifies approval. It was Tom Lee who said it effectively. It was in this year that governments and Wall Street finally started to see blockchain as a viable option for rebuilding. And that change is pervasive. Everywhere you look, there are new frameworks allowing institutions to hold crypto directly on their balance sheets, stablecoin rules, and the approval of ETFs. Cryptocurrency was considered a threat to conventional banking for a long time. It is now in the process of being secretly used as its operating system. In the same thread, Cathie Wood reaffirmed the idea, noting that stablecoins are the most prominent use case for digital assets at the moment. She referred to them as the conduit asset that connects centralized rails with legacy finance. She is correct. To prepare for what's to come, stablecoins serve as a practice run. Tokenized everything else can come after the system demonstrates it can manage trillions of dollars in tokens, securities, commodities, bonds, and international payment systems that facilitate their frictionless movement, such as XRP. A lot of individuals fail to notice that the whole crypto story has turned on its head. Will this eventually supplant the dollar? We need to know how quickly we can tokenize the dollar and transfer it on-chain. After that, you'll require rails capable of handling volume on an enterprise level. At the same time, you require low cost, liquidity, compliance, and speed. XRP's design is useful for that. In fact, it was crafted specifically for that very second. The interview with Tom Lee will now be resumed. Going into detail about his predictions for the market, he stated his belief that this cycle has the potential to push Ethereum tokens to $60,000 and Bitcoin to $2 million. Even though those figures don't add up, his explanation is quite apparent. He's not relying on fanfare, but rather adoption. He thinks this is more than just a bull run. A migration of institutions is beginning, and it all adds up. Today, MicroStrategy's market cap is approximately $100 billion, and the company holds hundreds of thousands of Bitcoin. However, Tom Lee brought up an interesting point that if Bitcoin reaches $2 million, MicroStrategy's holdings in the cryptocurrency will be worth $2 trillion. He likened it to a petroleum firm. The essence of oil is its asset. That value is amplified by the surrounding infrastructure. Decentralized applications, DApps built on Ethereum, would thus constitute the new technological backbone in this alternate reality, while Bitcoin would be considered digital property and XRP's role, if any, as the transactional bridge that moves value between all of them. Another equally important viewpoint was offered by Kevin O'Leary. He claimed that the institution's reluctance to completely embrace crypto isn't due to a lack of belief in it. That's because of the unknown. The gates will open wide as soon as regulations are made clear, and we're witnessing that same thing taking place at this very now. The ETFs will show it to you. Legislators are beginning to differentiate between blockchain innovation and speculative trading, as seen in recent parliamentary hearings. Above all else, it's evident in the covert integration of crypto rails into the systems of financial infrastructure corporations, like Fidelity, Visa, and PayPal. Because of this, those who have a firm grasp on the situation do not let themselves be distracted by the short-term volatility. The biggest corporations in the world are running the infrastructure for a brand new financial network. All the while, retail traders are freaking out about daily candles that explains the self-assuredness with which Cathie Wood and Tom Lee delivered their forecasts. They aren't putting their money on meme coins or trends in trading. They are putting their money on the system changing over time. Consider the relevance to XRP once again. As the market witnessed this week, Ethereum scalability is its biggest vulnerability. The issue with the toll booth, exorbitant gas fees of over $1,000 to complete a single transaction. Enterprise adoption cannot be sustained in that manner. This was also noticed by Binance. Extremely unpredictable market conditions, which led to a temporary drop of certain of its stablecoins from the dollar. On the other side, the XRP ledger managed its volume without experiencing any downtime. Because of that, it is subtly gaining respect from established institutions. The ability to avoid network congestion is crucial for multinational banks and payment processors that handle billions of dollars daily. You must have dependability. Looking at the numbers, that dependability is what's being rewarded. In secret, financial institutions and tech startups are experimenting with XRP ledger-based settlement methods that do not involve SWIFT at all. Even though the figures aren't out in the open just yet, the story is told by the amount of transactions stored on the blockchain. No changes to the instant settlement timings, and volume is up. For that reason, the short-term price cuts do not represent the true adoption rate. Why? Because adoption takes time to affect prices. Subsurface pressure increases up to the point of eruption. Compare that to the events surrounding Bitcoin several years ago. Under $10,000 was its trading range for over 10 years. Hundreds of times, people said it was dead. While the price remained mostly stable, however, infrastructure was subtly being developed. Marketplaces, safekeeping, financial instruments, ETFs. Finally, the market caught on to what was true all along. Something had changed inside the system. It had grown up. XRP is currently in that phase. There is clarity in the law. Curiosity from institutions is present. I have proven the use case. The only thing left is for liquidity to catch up to utility. It is from the same line of reasoning that Tom Lee derives his optimism over Ethereum hitting $60,000. The inflows will be massive once institutions can easily invest in crypto assets without interference from regulators. Entities that handle trillions of dollars include pension funds, sovereign wealth funds, large enterprises, and others. The game changes the moment even a fraction of that capital goes into cryptocurrency. After Bitcoin and Ethereum, the long-term winners will be utility-based networks like XRP, which are designed for real transaction flow and not a store of value story. That's looking at the big picture. It is on this particular issue that advocates such as Cathie Wood are concentrating. She's putting her money into the businesses that are laying the groundwork for tokens, not merely into the tokens themselves. So, while average traders keep staring at price charts and trying to figure out why XRP isn't responding faster to positive news, the big players are discreetly building up their positions and putting systems in place that will need XRP liquidity in the future. The importance of a diverse blockchain infrastructure is highlighted by Ethereum's congestion problems. A single network that goes down during heavy traffic cannot support the world's financial system. That's why integrating different ledgers into a single global system, Ethereum, Bitcoin, XRP, and others is emerging as the next major topic. Yet another excellent point was made by Kevin O'Leary. He predicted that businesses that enable digital assets to communicate with one another will be the ones to reap the next $1 trillion in profits. XRP's technology was designed from the ground up to be interoperable. So, this kind of thinking provides it an edge. Valuation in any shape or form is what matters most, not XRP per se. One may begin to understand how this aligns flawlessly with XRP's long-term objective when one considers the current discussions taking place among major central banks, the International Monetary Fund, and the Bank for International Settlements on digital currencies, cross-border settlements, and liquidity bridges. This is a long-term change, but when it occurs, it changes the way wealth is distributed. Those who grasped the concept of the internet in 1995 are now the ones who have amassed billions by 2020. Upon the system's complete activation in 2025, the asymmetric positions will be held by those who comprehend blockchain infrastructure. So, as Bitcoin, Ethereum, and Binance all adapt to their new reality following October's turbulence, keep an eye on what's being constructed behind the scenes. The top 1% of investors pay more attention to positioning than the average investor does to prices. At the moment, the focus is on assets that address practical issues such as rapidity, settlement, transparency, and worldwide connectivity. There will be a significant shift of wealth in the near future. And as we'll see in the section that follows, the experts who have been keeping tabs on these patterns for the longest, from Tom Lee to Kevin O'Leary, are finally converging on a single clear prediction. The entire financial system will be reshaped by this next crypto cycle, not just the headlines. There will be a dramatic shift in the way the world's financial markets function as a result of the next crypto cycle. Reason being, this is not a hypothetical wave, it is the first of its kind. The groundwork for a new monetary age is before us, one in which the transfer of value is as frictionless as the transfer of data, and where blockchain technology serves as the invisible glue that holds everything together. That's the meaning behind Kevin O'Leary's prediction that tokenization will affect every asset on the planet. He was being quite serious. What he meant was that the world is already heading in that direction. Many organizations, including central banks, are investigating the possibility of putting already existing assets, such as commodities, stocks, and currencies, on a blockchain. Whoever owns the rails, the infrastructure that transfers all that tokenized value from one location to another, will be the true victors when that occurs, not the people who are chasing coins for short-term gains. XRP fills that need. Reason being, there will be a greater need for rapid, hassle-free cross-border settlement as more value transfers digitally. The current international transaction clearing time for the legacy banking system is 3 to 5 days. While it may not be a big deal when you're shipping $500, delays like this cost billions annually when international trade is conducted on a global scale. That issue is resolved by XRP. The settlement process is reduced from days to seconds. Because of this, the major stakeholders are keeping a careful eye on developments. In the background, Ripple is discreetly growing its connections with financial institutions and payment processors. Additionally, XRP's long-term value proposition is enhanced with every new integration. Efficient operation is the key, not marketing fluff. The technology behind XRP is displacing antiquated payment rails in the same manner that the internet did with fax machines. Add to that what Tom Lee and Cathie Wood have already said. The rate of institutional uptake is exceeding expectations. Rules are being tightened. Various exchange-traded funds are undergoing approval processes. Trust in stablecoins is growing around the world, and in that setting, assets that are both useful and compliant will be the ones to prevail. The decentralized app ecosystem will be maintained by Ethereum. Cryptocurrency like Bitcoin will always be a safe haven for wealth. Yet XRP has a distinct purpose. It serves as the connecting link for networks, currencies, and financial institutions that must transfer value more quickly, cheaply, and internationally. And the interesting part is this. The top wallets, the true whales, are stealthily amassing assets as regular investors freak out over temporary price fluctuations. Trust the truth of on-chain data. Even when the market dropped, the largest XRP holders didn't sell, they proceeded to add. The early positioning window will have passed by the time the mainstream recognizes what's happening, which is why they are doing it. With each significant change, the same pattern emerges. Few anticipated that. The internet would drive international trade in 1997. Not many people in 2008 thought that mobile apps would grow into trillion-dollar markets. The same skepticism persists regarding blockchain infrastructure in the year 2025, and it is precisely the spot where the next economic boom will begin. That's why digital asset infrastructure will produce the next crop of multimillionaires, according to Kevin O'Leary, rather than through buying and selling coins, but rather by controlling the infrastructure that processes them. It all comes down to who controls the infrastructure that carries money across the world, the funds that keep markets running, and the connections between different parts of the economy. The true wealth creators will emerge from the groups responsible for creating and controlling the infrastructure of the emerging blockchain and digital finance industries. The emphasis is changing from price guessing to owning the technology that powers the entire ecosystem, moving away from speculation and towards structure. Also, the world's governments are keeping an eye on this. Efficient settlement layers are necessary for the digital currencies that central banks are testing. Interoperability frameworks have already been discussed by the IMF and the BIS. Which technological advancement satisfies all of their requirements? Quickness, conformity, extensibility, and practical implementation. XRP. The emphasis will move from which coin will pump to which network will power the system as the market changes. Old systems integrate with new technology, and value becomes as mobile as information. For more than 10 years, XRP has been clandestinely laying the groundwork for that very position. Everything from the interviews to the statistics to the voices of those like Tom Lee and Cathie Wood, who see beyond the surface level and into a worldwide financial realignment and digital reset of money flows, suggest this. The most astute investors, meanwhile, aren't sitting around waiting for consensus to validate their bets. Already, they are meticulously and purposefully putting themselves in assets that are built to withstand regulation, scale internationally, and integrate with the biggest financial institutions in the world. XRP serves that purpose. Therefore, the largest holders are choosing not to sell. The accumulating process continues to absorb every dip for that precise reason. They are wise to the fact that assets having practical applications will outperform all others once the global liquidity migration kicks in. So keep in mind that history doesn't favor those who respond as the storyline evolves and the market moves into its next phase. Those that position themselves early will be rewarded. This next financial era's positioning window is closing faster than most people realize. I detail the exact steps that successful investors are doing to prepare for the next phase, including how they spot huge chances before they become popular in the XRP Millionaire Blueprint. A video, infographic, and essay outline the exact framework the wealthiest 1% are using to get ready for this worldwide financial upheaval. It's a comprehensive, high-level instruction. Just below this video in the pinned comment, you'll see